Have you ever heard people talk about the stock market being in a bull or a bear phase and wondered what it actually means? These two terms often come up in financial conversations, and while they sound simple, they carry a lot of meaning about how the market is performing, how investors feel, and even what the economy might look like in the near future. Understanding the difference between a bull market and a bear market can help you make better financial decisions, whether you're investing in stocks, crypto, or any other assets. So, let's break it down in the simplest way possible. Before we dive deep, make sure to hit that like button, subscribe to the channel, and turn on the notification bell so you never miss out on more financial and investment insights. And don't forget to share this video with your friends who also want to learn how money and markets really work. Now, let's start with the big question. What exactly is a bull market? A bull market is when prices are going up, and investors feel confident about the future. Imagine a bull charging forward with its horns pointing upward. That's why it's used as a symbol of rising prices. In a bull market, people are optimistic. They believe the economy is strong, companies are making profits, and things will continue to improve. Because of this, more people buy stocks, crypto, or other investments, which pushes prices even higher. It creates a cycle of positivity. When investors feel good, they buy more, and when they buy more, prices rise, making others feel even better. A good example of a bull market is what we saw between 2009 and 2020 in the stock market. After the financial crisis of 2008, markets bounced back and kept growing for more than a decade. Technology companies like Apple, Amazon, and Microsoft grew massively during this time, creating huge wealth for investors who stayed in the market. Even in the crypto world, the massive surge of Bitcoin in 2020 and 2021 can be called a bull market phase. On the other hand, a bear market is the complete opposite. A bear market happens when prices are falling, usually by 20% or more from recent highs, and investors start to lose confidence. Think of a bear swiping its claws downward. That's the symbol of falling prices. In a bear market, fear takes over. Investors start selling their stocks or crypto because they're worried about losing money. The more people sell, the lower prices go, which causes even more fear. This cycle of negativity can last for months or even years. For example, during the global pandemic in early 2020, the stock market suddenly crashed, and within a few weeks, prices dropped dramatically. That short period was a bear market. Another example is the 2008 financial crisis, when markets fell sharply, wiping out trillions of dollars of wealth. In crypto, the sharp drop in Bitcoin and other cryptocurrencies during 2018 is another clear case of a bear market. But here's something important: bull and bear markets don't last forever. Markets always move in cycles. A bull market will eventually cool off, and a bear market will eventually recover. It's like the seasons: spring and summer bring growth, but autumn and winter bring slowdowns. Yet, after winter, spring always returns. That's how markets work. Now, why should you care about bull and bear markets? Because knowing the difference helps you understand when to be cautious and when to be aggressive with your investments. During a bull market, opportunities are everywhere, but it's also easy to get greedy and overinvest. People sometimes forget that prices won't go up forever, and that's when mistakes happen. In a bear market, fear can stop you from investing altogether, but that's often when the best opportunities appear. In fact, many of the world's greatest investors, like Warren Buffett, recommend buying during bear markets when prices are low, because that's when long-term wealth is built. Another key difference is the psychology of investors. In a bull market, optimism rules. People talk about easy money, and even new investors jump in because they don't want to miss out. In a bear market, pessimism dominates. People sell investments at a loss, often out of panic. Recognizing these emotions, greed in bull markets and fear in bear markets, can help you avoid making bad decisions. So, how can you protect yourself in both markets? The answer is balance and patience. In a bull market, don't just chase rising prices. Make sure you're investing in quality assets that have strong long-term potential. In a bear market, don't panic and sell everything. Look at it as a chance to buy strong investments at a discount. Remember, the market rewards those who stay disciplined and think long-term. In simple terms, a bull market equals prices are rising, optimism is high, and people are buying. A bear market equals prices are falling, fear is high, and people are selling. Both are natural parts of the financial world. They reflect human emotions, economic changes, and global events. Understanding them can give you the confidence to stay steady, even when markets are uncertain. To wrap this up, the next time you hear the words, bull market, or bear market, you'll know exactly what they mean. One represents growth and optimism, while the other represents decline and fear. But both are essential parts of the investing journey. If you can learn how to handle both, you'll be in a much stronger position to grow your wealth over time. Thank you for watching. If you found this explanation simple and helpful, don't forget to like this video, subscribe to the channel, and hit the notification bell so you stay updated with more easy financial breakdowns. Share this with your friends who are trying to understand markets, and drop a comment below telling us whether you've experienced a bull market or a bear market yourself. We'd love to hear your story.